Welcome to this deep dive. Today, we're really getting into Capital Alphabet. They're an investment management firm that's, well, been making some waves.
Definitely, with a pretty unique strategy and, frankly, some impressive performance numbers.
Yeah, so we've got their latest fact sheet, the August 2025 update, and we're going to try and understand the how and the why behind what they do, more than just the numbers.
Exactly. Our mission, if you like, is to pull out the key nuggets, understand their goal maximizing long-term value, and how they seem to keep beating the S&P 500.
It's the consistency that's interesting.
It really is. It points to a very disciplined method.
Okay, so let's jump straight in then. Their objective: maximize long-term value, outperform the benchmark. How's that actually panned out?
Well, the numbers are quite compelling. Since they started in June 2022 up to August 30, 2025.
Right.
They've hit a cumulative return of 157.48%.
Wow. Okay.
Now, compare that to the S&P 500. Over that exact same period, it did 62.82%.
Big difference.
Huge. So think about it like this. $100,000 invested with them at the start. That'd be worth $257,475 now. The same $100 K in the S&P 500 would be about $162,819.
Okay, that puts it into perspective. It's still relatively early days, but
the consistency, as you said, is striking already.
And here's what really caught my eye. They've just hit their fourth straight year. Fourth year with over 20% gains.
Right.
But more than that, remember 2022, the S&P dropped, nated 6.69%?
Yeah, a tough year for the market.
Well, Capital Alphabet posted a 29.91% gain.
Incredible, isn't it?
That's not just outperformance. That feels like a different kind of resilience altogether. Yeah. So how did they pull that off when things were so rough?
That's the million-dollar question, right? And it seems rooted in their very specific core strategy. They focus relentlessly on finding high-quality companies with what they call substantial economic moats.
Right, the competitive advantage, like a castle moat.
Exactly, something sustainable. Could be tech, network effects, cost advantages, you name it. They also look for a high return on capital employed, ROCE. So companies that are really good at making money from the money they use.
Efficient.
Very efficient. And crucially, a huge margin of safety. Buying something for, way less than they think it's actually worth.
That safety buffer.
Precisely. Plus, it all has to be run by management they trust, management that thinks like shareholders.
Okay, let's unpack this a bit more, because a lot of funds chase trends, right? Maybe pile into the magnificent 7 stocks everyone's talking about.
Sure, Apple, Microsoft, Amazon, etc.
But Capital Alphabet says they don't heavily concentrate there. And they don't use leverage.
Yeah.
What's the thinking behind that discipline, that sort of limited risk approach?
It seems to be about focusing on, fundamental intrinsic value, not just what the market's excited about right now.
Okay.
By avoiding leverage, they sidestep that extra risk. Leverage magnifies gains, sure, but it also magnifies losses.
Right. Dangerous.
And not concentrating too heavily in just a few big names, even dominant ones like the Mag 7, gives them diversification. It means they aren't just riding a wave. They're, digging for value that can hopefully last through different market cycles.
That discipline ties right into their risk philosophy, doesn't it? Those two famous rules.
Ah, yes. Rule #1 and rule #2.
Rule #1. Never lose money. And rule #2. Only bet on no-brainers likely to beat the index long-term, and never forget rule #1.
Quite punchy.
It is.
Yeah.
But never lose money. I mean, that sounds almost impossible in investing. How do they actually interpret that? How does that work in practice?
Yeah, it's a great question. It's not about literally never having a stock go down temporarily.
Okay.
It's more about minimizing the risk of permanent capital loss. Their due diligence has to be incredibly thorough. That margin of safety has to be really significant.
So it guides their selection process.
Exactly. It forces them to walk away if the downside isn't clearly limited, and that only bet on no-brainers part. That suggests an almost obsessive focus on clarity. They want businesses they can really understand, predict to some extent. Nothing too speculative or complex, even if it looks exciting.
So clarity reduces risk.
That seems to be the idea. Find those opportunities where the odds just feel overwhelmingly stacked in your favor for the long run.
And you get a real sense of conviction. The portfolio manager, Vinu Vallabhani, invests all his own retirement savings alongside clients.
Right. Eating our own cooking, that really does build trust.
Definitely. So how does it work structurally for clients? How are the investments held?
Good point. They use separately managed accounts, SMAs.
Right.
These are held at Interactive Brokers, or IBKR. And the big advantage for you, the client, is direct control and transparency.
How so?
Well, unlike a mutual fund where you own units with an SMA, you actually own the individual stocks and bonds directly in your name, in your account.
Ah, I see. Full visibility.
Exactly. You can see every holding, every transaction. It aligns their interests with yours because they're managing your specific portfolio, not just a big anonymous pot.
So if someone listening is intrigued by this, by the discipline, the approach, what are the practicalities? Minimum investments, fees?
Well, they've actually lowered the minimum entry point recently down to $25,000.
Okay. More accessible.
Yes, though they do recommend having over $100,000 for, optimal results. It just allows for better diversification across their picks.
Makes sense. And fees?
The fee structure varies. For qualified clients, there are performance fee options. For others, it's typically a 1.5% annual management fee. So different ways to align incentives.
Okay, so as we wrap up this deep dive, what's the big takeaway here from Capital Alphabet? For you listening, it seems like more than just impressive returns. It's a really clear case study, isn't it?
It really is.
How a super defined, very disciplined, long-term strategy, focusing hard on quality, on managing risk almost obsessively, can potentially lead to significant, and maybe more importantly, consistent outperformance.
And I think the broader point, the connection for everyone, is that understanding the why behind any investment approach.
The philosophy.
Yeah, the core principles, the risk management, the search for real value,
Right.
That's ultimately just as critical as knowing what you're invested in.
Right.
Which I suppose raises a really important question for you, our listener. How well do you truly understand the why? The foundational principles driving your own long-term financial path.